If you look back in history since 2000, all of the best performing funds of all times were the ones that were formed right in the middle of the downturns. 03, 08, 09. These are the vintages that have always been the best. And what that means, it's a proxy for investing, which is it's the hardest time right now. It's when you have the shakiest hand when you're writing the check, but it'll probably be where all of the real money is made, or the real generational wealth, both for the entrepreneurs who have the courage to start and the investors who have the courage to invest.
Chamath Palihapitiya has recently switched gears and believes that the downturn in markets we have seen over the past year has either already bottomed or is going to make its bottom over the next few weeks. In his latest interview, Palihapitiya speaks on how the lows of the bear market, like where we are currently at, are the best times to make generational wealth, and that hard times will only weed out bad ideas, bad practices, and bad management, which will give way to a new bull cycle with stronger players. Make sure to stick around to the end of the video where Chamath, alongside David Sachs, explains how a ton of money will be made in the next cycle and how focusing on net worth is actually a poor way to generate wealth. Instead, they explain what they focused on to amass huge success and wealth themselves. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance videos, consider subscribing or liking the video. It's free and you can always change your mind.
There was a story that I heard in New York. I was talking to a really well-known hedge fund or family office, and they were talking about how they were meeting with a CEO of a fintech unicorn, very well-known fintech unicorn. And they said they left the meeting and they said, this person had an unbelievable disrespect for money. And it was the most arrogant interaction that they had ever heard. And they said, under no circumstances would we invest in this guy in this company at any price. And, lo and behold, a year later, that company is now visibly going through a bunch of hiccups. And it just reminds me that, Jason, we've always had two problems when times are good. Problem number one is that there's never been a check and balance on that kind of behavior, a lack of respect for capital, and almost a disregard for business models, which is just inexcusable. And I think it's partly the fault of a very young entrepreneur, but it's also partly the fault of a board who doesn't know how to direct that person. The second thing is we've always had this big tech put on the table where every time you would try to really hone in on running a lean, highly efficient organization, the alternative would be to go work at, Google, Facebook, Apple, Amazon, Microsoft, where the terms are just completely different to what the experience was, at a startup. And the bigger the gap, the harder it was for you to be able to hire and retain good people without just copying them. And now that that's also coming off the table, that is a key moment. So Gurley is 100% right. There is no longer the big tech put. Those are the generals that are about to get shot over the next 8 to 12 months, in my opinion, in the public markets, in terms of market cap and employment and perks. And then second is that these really thoughtful investors who felt pretty deeply disrespected will now be able to call the shots. And these founders will have to come back hat in hand and either apologize or just completely find a different religion. And I think in that, you'll have a lot of amazing opportunities to build companies.
When times are as frothy as they were, a lot of bad ideas get funded and there's a lot of bad behavior that occurs. I don't think all of it's intentional. Some of it is just the lack of discipline that when capital is just so freely available, people were building their businesses in ways that were optimizing solely for one variable, which was top line growth. They just weren't paying enough attention to gross margins or burn. And when you then have a downturn and capital is not so available, you have to build your business in a much more capital efficient way. And you can't create fake businesses where you're buying growth that's not economically justified, where you've got negative unit economics around the growth. So I think that this downturn is going to create a shakeout. It's going to weed out bad ideas, bad practices. There's just a lot of one-trick ponies out there who've optimized growth but don't have a real business.
It is extremely difficult to convert TVPI to DPI, the value, paper values into actual distributions, and that takes a skilled hand. And I think that a lot of young folks were hired into venture that fundamentally did not know what they were doing. They've neither ever built a company or helped build a company or actually learned how to generate returns, but they became very good at buying free call options on companies. I remember like a lot of people, the way that these young people, I heard a story that you would sell against Gurley, right? So let's just say you were trying to do a deal and Bill gives you a term sheet from Benchmark and you get, somebody else. The young folks were like, oh, Bill's too negative and he doesn't get it. And they would try to convince these entrepreneurs that, these rainy days don't happen. My experience with Gurley is he is the most sophisticated investor of our generation. And what I mean by that is, he was trained as an equity analyst that really understood business models and cost of capital. And so in a moment like this, the way that Gurley would help you on a board is meaningfully more important than how some, middling VP at some rando startup who's now a junior partner at a venture firm, because that person has literally no clue. And so these companies are going to go through a very difficult moment, which again is the reason why a good steady hand who knows what they're doing will make a ton of money in this next cycle. There are moments when what we do reflects in value that frankly where we are over earning. And then there are periods where what we do is under reflected and we are under earning. And so the through line has to be that you need to survive in both good times and bad times, which means you got to like what you're doing. And if you get caught up in a numerical number, there's all kinds of math you can do to make it look a lot bigger than it is, but it's all meaningless. Somebody told me in my 20s when I was at AOL, he said, if your goal should be to just be in the upper few percent of your age bracket and just enjoy what you're doing. And he said, let time take care of everything else. Because as long as you find something you decently enjoy and are good at, you'll just get better and better at that thing. And then at some point, you will lose track of what the, measurement of that is because you're just too caught up in how much you enjoy doing the thing. And I thought that he had no idea what he was talking about. And now 25 years later, I can tell you he was totally right.
I think after, observing outcomes for 25 years in tech, what I would say is that if you're smart, hardworking, don't have behaviors that sabotage yourself and, take intelligent risks, you will be successful in this business. I mean, technology is such a wind at your backs. It's such an engine of wealth creation. How can you not do well? But the exact magnitude of how well you do, I think it is substantially affected by timing. And, like if you were employee, whatever number X at Google, you're going to do better than most founders, even of a unicorn company. And when you found your company and then when you exit, what the market is doing, those things have a huge impact on the magnitude. So, whether you end up being, a billionaire, a centimillionaire, a decamillionaire, whatever you want to, those things are very affected by timing and chance, but not whether you're going to be successful at a substantial level. And so just, be smart, be hardworking, don't sabotage yourself, get into tech and you will do well. The exact amount of how well you do will be dependent on some, stochastic factors, but not the fact that you're going to do well.
We are enormous beneficiaries of having been born when we were, because we are a bunch of late 40 and early 50 somethings that in the prime of our career
42.
in tech, the Federal Reserve took rates to zero. And we had no idea a priori how important that would be in all of our outcomes, but they were. All of that hard work was done beforehand by an entire cohort of people that had to fight much stronger headwinds than we had to fight. So, David, I just want to build on that. Like, we were extraordinarily lucky. And so don't get caught up in that because there's all these factors you cannot control.
I'll say one more thing that I think is the most important observation I've made in terms of whatever it is, building wealth over time, is to make sure you're building equity in yourself. If you're in a services business and every day, and whether that's serving the clients of the company you work for or just serving clients on behalf of yourself, and everything you do is a transaction, and that transaction doesn't build on itself, doesn't compound value in some way, then you're missing out on an opportunity. Every year that goes by that you're earning income where you're not building equity is a non-compounding year. And it's compounding equity value that I think ultimately pays off for you as an individual. And I can give a lot of examples of this, but if you're in let's say a brokerage business and you just do deals and you might have a good year, you might have a bad year. The real question you need to ask yourself is, what is compounding? Are you growing a client base? Are you growing your skill set? Are you next year able to do more things or have more options than you had this year? And if the number of options you have is declining or is static every year, then you're limiting your equity value, and that ultimately will translate into limited wealth creation.
Can I chime in on that point around equity? So when I discovered what equity was, this was when I was in law school, and actually the guy who explained it to me was Antonio Gracias. A light bulb really went off for me because my dad is a doctor and I was on a path to becoming a lawyer. And in both those cases, you're a professional, and the way you get paid is you more or less charge an hourly rate. And so the amount of money you can make is capped, right? Just take the number of hours in the day and in the week, multiply it by your rate, and that's the most money you can make in a year. And the difference between that and equity is with equity, you own a piece of a business, and that business could be ultimately worth, any amount. And so your equity could therefore be worth virtually any amount. And so you're uncapped. And so just, if you want to have outsized success, you have to have equity in something. I think that is exactly right. If you're just basically working for wages, even if you are the best at what you do and you get paid an insane hourly rate, you can be successful, but you're not going to be uncapped. And so that's the beauty of Silicon Valley is all these companies offer equity to everybody.
And it's not just shares in something. You can actually get equity and create leverage in your life in this era more than any human has ever had in any era prior because of software and computing and automation. You can create a website that prints cash for you every day if you wanted to. You can create a service that you get leverage out of, and there's equity value in that. And I think that's really key because then you can go build another one, and you're building value over time. And that's just the most simplistic example of how technology today provides leverage that can really allow anyone to pursue a path of equity.